Hello, hello, hello. So, welcome to everyone, and let's rock and roll. Sorry, I'm a little bit late. I'm here in a hotel in London, in Heathrow, and I was just struggling to connect a little bit. But we are good to go. Who is excited? Do me a favor, type in the chat room. Who is excited to hear all about it today and what we are going to be going through? Can you believe it? I'm literally standing here in London Heathrow, and today we're going to talk about an investment opportunity in Manhattan. So type in the chat box and let me know if you're excited and where you're coming from. It's always interesting for me to know where you're coming from and just to get an idea around the world in terms of people and what your thinking is. And what would you like to get out of today? So what I'm going to be doing for you today is taking you through a launch. Now, one of the things that's really important, and I want to bring this up right up front, is that if I take you, so let's just go here and share my screen. So everything that I'm going to share with you is already on the platform. So let's just go here. And if you go, maybe I should just log in completely for you. So if I go Wealth Migrate, and you literally go here and you go sign in, and you go sign into the platform. And you can see on the dashboard here, everything comes up. So this is the deal that we're talking about. It's Catherine Street, Manhattan. It's a debt equity 50-50 blend equity release. When you click on this, you will notice that there is a video here, which is actually done with Garth Wellman. Okay. There is also a presentation that I did in terms of the Manhattan and why New York. There's a map in terms of where the location actually is. There's pictures of the building and what it's actually going to look like all the way through. So you can literally go and find all of this, whether you're live here or whether you're watching the recording, and you can basically go through it. You can see the returns. You can see when it's listed, when it's due to close, and who the partners are, everything about it. It's a mixed use deal, who the sponsor is and how long they've been around, and the risk. The risk is in value add. You can also go and download the documentation. So if you click on this, it'll literally download the documentation for you, and you can have all the deal information with regards to the deal. So you should have at your fingertips everything that you want, all the due diligence, everything is already here. And so what I want to do, and the way that I normally do this, is that I just run through a quick presentation to explain everything to you. So what I want to do is look at New York. Now, when we just go back a few steps, I want to start with the story of me investing in America. So you can see here that it was April 2011. Now, funny enough, I've been to America lots of times, but I went to America to buy houses for the first time in 2010. And I got such a fright. I thought the Americans would sell their sister. They were so desperate to make a sale that after 5 weeks of being in America, I went home with my tail between my legs because I like, this is just not going to work. And I went back with a different strategy in 2012. And I went with two partners, and we amalgamated our contacts, and we didn't try and go and find property. We went to find partners. So you can see here that we started off in San Diego, and then we sort of made our way across to Phoenix, Arizona, and we went right across America. You know, we went to 8 different cities in 9 days, looking at houses, looking at apartments, looking at whole buildings, you know, from everything from New York to Orlando. And what was so interesting was that, you know, no matter where we went, we met new partners, we got a better idea of information of what was happening on the ground. And we then came back to South Africa, and we presented, and we did these presentations all around South Africa because there were such good opportunities in America at the time. And, you know, at the time, the Rand was 8 Rand 50 to the dollar, which, you know, it's less than half of what it is now. And what's so interesting is that we went on to do multiple buyers trips. I think in the end, we did 16 different buyers trips, people flying over, coming and buying houses in America. And it really fulfilled the principle of diversification. How do you diversify across countries, currencies, assets, partners, and time? And ultimately, how do you build passive income? However, New York was always something that was a miss for us. It was too expensive. We couldn't make the numbers work. And so we never actually looked at Manhattan. We used to fly to Manhattan, but we never looked at any property with any serious there because we just couldn't afford it. We couldn't, literally, the deals didn't work. So what ended up happening was we went across to the New Jersey side, and that's actually where the Statue of Liberty is. And you kind of look onto Manhattan, and there were old buildings there. You know, you tended to look at like 3-story walk-ups, and there was stuff that was, you know, pretty derelict at the time. They used to talk about how you would put a coin on the floor and it would roll down, and, you know, depending on how quickly it rolled was, you know, how much repairs had to be done on the property, etc. And we certainly looked at some torrid buildings. And these are real life pictures. These are the pictures that I took looking at properties. We never bought any of these properties because we just couldn't make the numbers work. But what's so exciting now, and if you take technology into account, and the whole idea of kind of smart investing, is that now truly everybody has access to be able to invest in quality partners, quality opportunities, etc. And so this is what it's all about to live a life unlimited. Now, I'm not going to be giving you financial advice here, but what I am going to be doing is sharing with you, in my opinion, the highlights of what you need to look at in terms of this deal and the deal launch. Now, have we launched this deal already? Yes, we have. So this deal has already been launched. Like I said to you, you can actually go and watch a recording here with Garth Wellman, where he literally talks about it and why the family office and why he recommends it, and also why it's 22 minutes long. And he talks about why the blend. So the blend is where you've got an equity investment and you've got a debt instrument. And let's just say you put $100 in, $50 will go to debt and $50 will go to equity. So you get the benefits of debt and you get the benefits of equity, and it's blended together in terms of that process. Now, there was such a demand for this opportunity when it closed at the end of June, July, that sort of time of the year, was that we took our full allocation. So what that means is that we didn't want to give up any of our allocation because it was first come, first serve. So the people that invested first, so we invested back in December of 2023. The people that invested first got first access to be able to invest again. And we didn't want to give up any of our access. So we took our full allocation. And now there are some investors that are saying, hey, look, I've made my money. I want to be able to exit. So it's what we call an equity release. And that allows people to participate, new people to participate in this deal. It's existing, it's paying, and it allows those people to effectively get out of the deal because they've done their 18 months. They invested in December 2023. It was an 18-month investment. It's got to, the end of the 18 months. They want to exit, and we don't want to give up our position in the opportunity because it's such a good opportunity and there's so much demand to invest in it that we said, fine, we'll equity release you out and we'll replace it with new investors. Are you with me so far? Is there anything that I can help with so far? Any questions? Anyone got any questions that I can help you with? Please type in the chat box and let me know if you've got any questions. Okay, so I want to take you back through some of the highlights of this presentation and why I think this is important. If you use our global investment due diligence system, that's our GID system, and that's effectively how we always look at it. So what is the macro? Why America? Why New York? Why the why the partner? How does the deal metrics work, et cetera, et cetera, et cetera. So when you look at America, according to our global system, is still one of the best places in the world to be investing. And, specifically in terms of commercial property. And so let's look at the market fundamentals. Well, the New York is a highly favorable multifamily market dynamic. So that means that there's a lot of demand for accommodation in New York. The economic backdrop of New York is highly favorable for real estate investment. The city's economics has demonstrated robust post-COVID recovery, with GDP growth exceeding the national average, employment surging, and particularly in sectors such as professional and business services, leisure and hospitality, education and health. Manhattan's technology sector, known as Silicon Alley, is flourishing. Rental demand and rents in the city are at record levels, with a substantial portion of the population being renters and vacancy rates historically low levels. New York has occupancy rates are amongst the highest in the country. So that means that there's very, very few spots available for rent. In June 2023, the listed inventory in Manhattan was 10% lower than a decade. So the demand in New York just continues to grow, year on year. The market supply. The new supply pipeline has not kept up with demand for many years. This shortfall has become more acute over the past couple of years, with completions significantly below the already high long-term average. Already low long-term average. The result has been minimal increase in the rental housing stock. The expiry in June 2022 of the 421 tax abatement program, a critical multifamily developer incentive, has exacerbated the severely supply-constrained market. New permit applications declined 60% in the second half of 2022. In December alone, the year-on-year decline was close to 90%. in 2023 New York state budget cycle, the 2021A scheme was not renewed or replaced. Now, why is this important? Why am I talking about 2021, 2022, 2023? Well, the project kicked off at the end of 2023. Now, that's really important to take into account because it shows you the level of supply that is coming into the market in terms of demand. So if things, it's not about what's happening right now. It was happening back then when the project started, because that's the timing of when other projects would be starting in terms of that process. In a recent report, the Real Estate Board of New York estimates that New York will need to build 560,000 housing units by 2030 to keep up with the expected population and job growth. Between 2010 and 2030, only 85,000 multifamily units were built across the 5 boroughs, approximately half of which were market rate rental units. In terms of the location, well, this is something that I, sometimes battle, have to pinch myself to understand. But I mean, that there is the New York Stock Exchange. This is where the World Trade Towers are, et cetera, et cetera. And the location is literally just 3 blocks away. So if you look here, it's situated in the heart of Manhattan. The property benefits from exceptional location, just 3 blocks away from the newly revitalized East River Greenway. It offers easy access to recreational spaces and a popular route for drivers, bikers, and pedestrians. The property's proximity to the major transportation hubs include the FDR Drive, Brooklyn Bridge, and Manhattan Bridge, and multiple subway stations enhance its connectivity to various parts of the city. So extremely well located in terms of the process. In terms of the partners and the due diligence, Selwyn is part of the Callio family office team. And when you look at it, the man has a PhD and a CFA. He's got a PhD from Cambridge in England. And, both him and his partner, Glenn, have extensive experience in private equity, in property, working for some of the big investment banks and property funds. And they actually, Selwyn knows the developer personally. He's invested with the developer personally on separate occasions with him and his wife. And so it's a huge amount of relational capital, as in partners, and also due diligence in terms of the actual project to be able to participate. The partner on the ground is one that, this wasn't a deal that you're going to find in terms of, like in the yellow pages or on LinkedIn or anything like that. This is 100% due to relationships. So, and just to answer your question there, Gregory, can we book now and pay by the 10th of December? The answer would be that it's a first come, first serve, Gregory. So if you want to just type in the chat box what you're thinking in terms of putting the amount down, I can try and tell the team to try and reserve it for you, but it doesn't really work like that. It's first come, first serve. You fund your wallet and you go online and you actually, you participate. So when your money was ready on the 10th of December, you would then be able to participate in terms of that deal. The Rivington Company is the driving force behind the project, brings a wealth of expertise to the table with a combined century of experience in real estate development and ownership. Rivington's principals have successfully managed 4 projects currently under development in New York, 2 of which involve historical rehabilitations. Travis Stabler, who's the main person of the Rivington Company, has dedicated over 2 decades to real estate development and asset management of family offices in New York City and the surrounding metropole. His strategy focuses on acquiring, developing, and managing a portfolio of unique assets, emphasizing long-term hold perspectives and superior risk-adjusted returns. Travis has successfully led challenging entitlement planning, construction efforts, making the key driver behind Rivington Company's ability to manage complex projects. His experience includes the development of over 1.5 million square feet in 8 residential projects in New York City and the management of a real estate portfolio with more than 185 assets across the US. So you're dealing with a company and a leader who has extensive experience in this space. In terms of the actual property, it is actually an old church. So they managed to get a deal from the Catholic Church. And this is one of the unique selling points because the church had closed down and it's been renovated into about 50 apartments. And there's 2 things that are really good here. One is that they bought it at a really good price. So they bought effectively below market value, which is one of the key benefits to this project. And the other one is that it's got very unique spaces because when you look at it, the entire building is that whole old sort of church style, which makes it really unique in terms of the process. And when it gets redeveloped, all these unique features make for a compelling investment project. The property under construction is landmarked Catholic Church, School, and Rectory. Its historical reference is not only a testament to the architectural heritage of the city, but also presents an opportunity to revitalize a piece of New York's history. The landmark status provides a unique blend of charm and character that can be leveraged in the redevelopment. It's got mixed use potential. So the property presents the opportunity for mixed use with a focus on residential and commercial. The building encompasses a combined 49,939 square feet of space, making it versatile canvas for innovative design and utilization. Architectural charm. The high ceilings on each floor, as well as abundant natural light and air, create welcoming atmosphere throughout the property. Street-facing windows on two sides and rear yards along the northwest section enhance the ambience and functionality of the space. So just before we go there, I want to just show you and go back to those pictures. So one of the things that I really like about it is that it's very hard to recreate this if you have a new development. So new developments would obviously just be big boxes, but look how the roof has all the shapes and everything else. And it's this very unique component, which is going to be very compelling for, people to live in, people to own, people to rent. And you can see the very high ceilings here. All of this is very, very important in terms of the overall process. So let's go back. The property is nestled between the Two Bridges neighborhood, which is strategically located between Brooklyn and Manhattan bridges. The neighborhood has witnessed substantial development in recent years, evolving from a working class and immigrant community into a vibrant mixed-use area. The market potential. The Two Bridges neighborhood is poised for continued growth and increased property values with several large-scale development projects in process, including the construction of a new pedestrian bridge and the development of a waterfront park. It promises a dynamic and appealing environment for real estate investors. The purchase price. So this is what I was telling you, that they bought it at a very attractive purchase price. The property is slated at $14.5 million, which is $250 a square foot. The purchase price represents a significant discount compared to the market rates for downtown Manhattan land, which have historically ranged between $500 and $1,100 per square foot. So just look at that discount, $255 to the market rates being somewhere between $500 and $1,100. The property's qualification in terms of historic tax credits further enhances its attractiveness by providing a direct subsidy of $10 million towards the redevelopment. Another key point to bring about. And so these are just some of the pictures here. I forgot these were actually coming up in the PowerPoint. So it just gives you the look and the feel, and you can see the really high ceilings, the windows, etc., which just, you can see the high sort of church roofs, etc., which will create a massive, beautiful ambience for the people to live in, basically. And then this is what it currently looks like. So, it was an old rectory, an old school, and so it's all been renovated in terms of the process and what people can actually expect. So you can kind of see, what it looks like now and kind of what they're wanting to turn it into in terms of the process. And then again, what does it look like now and kind of where they want to go. Now, in terms of the investment opportunity, let's go now because I think it'll be better to go to the platform here. So you're looking at a total return of about 15.8%, so just short of 16% total return. It's a 7-year investment, and you're looking at a cash-on-cash return of about 5%. Now, the reason is, again, that it's a blend. So half of it is debt and half of it is equity. Okay, so Gregory, I will make a note and I'll let the team know the amount that you are looking to invest. And I'll make sure, I'll tell you what I'm going to do, Gregory. I'm just going to put in my my WhatsApp. If you want to, just send me a WhatsApp and I'll help you get it sorted. Okay, so there's my WhatsApp. If you need the code, it's +27. There we go. I'll send it to you, Gregory. Okay. Now let's just look into how this works. So let's go back to the brochure here, because I think this is quite important. So you'll see here that when we originally launched this, there were two options. There was an equity option and there was a debt option, equity and subordinate loan debt, same thing. So if you look here, everything that I've already spoken about is effectively repeated here. But the one thing that I just wanted to share, which I think is important, is just the timeline. You can see when we originally got involved. So myself and a couple of other investors got involved right at the back end of 2023, like I said, November, December 2023. And they did all the planning, and that took, you know, the sort of 12 to, well, effectively 18 months. It took it through to June this year. Now they're in the construction phase. So it's going to take sort of 2.5 years to finish the construction. So that's where they do the renovation, etc. And then they, you know, so the people that are getting involved in the debt side of it, they would earn debt for the entire time of the construction. And then at the end, they would be, you know, given their money back, and that's the end of the investment. For the equity holders, they own a piece of the property. So then there's a hold period. Generally, a hold period is anywhere from 3 to 5 years. And then they sell the property. So once they've stabilized the rent and made sure that all the income is attractive and they can sell it on to a big fund or an institution, then the equity, you know, people will get a nice capital uplift in terms of, you know, capital growth. So what Garth recommended to his family office clients and to our mastermind clients was to do a blend, which is, you know, I've taken you through all these conversions, but you can see here, this is what I wanted. So you've got equity at 50% and you've got debt at 50%. So the capital raised here is 5 million. And you can basically see the entire period and the hold period, and then the debt, again, you can see is a 4-year investment. So the reason that on the timeline here, it says 7 years is because the debt period is 4 years and the equity period is a total of 7. And because we're doing the blend gives you a target return. So, you know, you're getting on the equity side, you're getting a 20% plus total return, but obviously there's no growth on the debt. On the debt side, you're getting an income of roughly 10%. And you can see they're paying 10.1%, and it's for 4 years. By doing the blend, you're getting an income return of roughly 5.5%, and you're getting the capital growth. But when you put the two together, it works out at a total return of, just do it here quickly. No, that's the wrong one. Sorry, that's not what I wanted to do. It's, I need to toggle between these. So you can see that you've got a total return of 15.8%, and you got so that's including income plus capital growth, that's year on year, the IRR, internal rate of return, and then the cash on cash, which is your income per year, is 5.05% in terms of. So again, you can go and read about it. It's all in the brochure, but I just wanted to explain this in terms of people. I've been through the highlights, but again, you can go and read the you know, what is happening in multifamily, what is happening with deal specific. The key thing here is this value add that I've already spoken about. So it's this, you know, the price that it was purchased at. You know, in property, they always say you need to buy from a motivated seller. Well, the church, Catholic Church, was motivated, so they got it at a really good price. And the second thing is that they've got these tax credits. Then you've got obviously the partner that we've spoken about. If you want to look at the economics, you can see exactly how it works in terms of cash flows and everything else. With the exit assumptions, it's all here, how they've worked out the exit assumptions, where the effective return. So when you've got a target return, that's what they're targeting. In terms of risk management, these, you know, every investment has risks, and it's better to talk about those risks. So you've got historic preservation. So you're taking an old building and you're preserving it, which obviously you've got to have someone who's really skilled at that. And the good news is that Travis, the CEO, and the company Rivington has done this many times. Construction scope and cost. Well, with any development, there's always execution. So again, you've got to be dealing with a partner that has done this before and has tremendous experience. Financing, you've got to make sure that they've structured in their financing, which they have done. The market conditions, well, again, you know, you are looking at a 7-year time frame, 4 to 7 year time frame, and so things happen in the market, and that's why, you know, it's really important to take an extremely robust market like New York that has ridden many storms, and is still the financial capital of the world in terms of where it's actually going. The residential leases, you know, so obviously when the project's finished, it'll be coming into the market, and they want to lease up all the projects at the same time. All the properties at the same time. Obviously, the retail is exactly the same. And then finally, there's the operational execution in terms of it. So nothing untoward, nothing different from any other property development, but that's why the due diligence is so important. You can again go through in more detail. A sponsor in America is what they call a partner, but it's the same thing. And you've got the entire project team in terms of where you're at. And so that, I think if I go back to my PowerPoint, is pretty much everything that is key with regards to this investment opportunity. How do people participate? Well, by using our platform, this is your investor bank account. You fund your wallet. It goes on our platform, which is the Wealth Migrate platform. We then aggregate the investment opportunity. So this is the Manhattan investment opportunity. We aggregate all the investors that are keen to participate, goes through a tax-efficient vehicle, and we've got deal ownership. And then when the deal gets paid, the money comes out and it effectively goes back into the investor wallet, and then people can reinvest it or they can spend the money on whatever they want. But that's a simple bird's eye view of how it works. When the money comes back, it goes in the deal wallet, and from the deal wallet, it goes directly into the investor wallet. I've been through the risks, but just in terms of, I think I've spoken about the market changing, the development, the project, planning, financing, costs, and foreign. So foreign currency, that's just, if you, depending on what currency you're investing in, the strength of the US dollar. And then the last one is the interest not being paid by the developer. And that's one of the reasons that the due diligence on the partner is so critical, basically, in terms of where they are. Right. So in summary, you're buying a property at 30% below market value. That's really important. The zoning is already in place. You've got an established partner with long track record. It's a niche focus, residential conversions in New York. You're putting their money in. So the partner's putting their own money into the deal. They put roughly $8 million into this deal, which I think is really important. There's strong fundamentals for New York and especially Manhattan. Location. Obviously it's literally right next to the New York Stock Exchange. It's a unique building, so it's a trophy asset. In America, they call it trophy, like something that's unique, something that stands out. It's got architectural charm. It's an income-producing asset. So if on the debt side, it's a 10% cash-on-cash return, and with the blend, it works out at 5.5%. But then you're also getting the capital growth. The capital is protected by first mortgage. So on the debt component, there's a first mortgage over the property. So your capital is protected with a lower loan to value. And then the 12 to 18 months, that's not applicable. So I'm going to take that out because it's basically seven years investment. That was the original one, was 12 to 18 months. And that's now there's a couple of people, very few to be honest. I rolled over and most people rolled over, but a couple of people just wanted their capital out. And then also the Calio, which is our family office network, and the due diligence that they've done. So those are the 12 key things, if you want to screenshot them, that I believe, on the previous one, we went through the risks. And on this one, it's what's the opportunity. And what I always try and do in a deal launch is keep it simple and easy for people to understand in terms of that process. So again, we were struggling to get access to this deal. And that's why we took our full allocation. And now with regards to getting people on the platform, we're now allowing people to participate. And if there effectively are 3 people that want to do an equity release, and that allows new investors the opportunity to participate. And I think that is it. In summary, the investment overall encompasses a well-structured financial arrangement, offering investments a clear and secure path with flexible investment terms. So that's just, I'm not going to, this is the original one. This comprehensive financial strategy is designed to maximize returns while maintaining a prudent level of risk management and situated right in the middle of Hampton. So just remember that this is effectively now is 7 years, okay, and it is 5.05% per annum, and it's paid half yearly, okay, and 15.5% IRR. Okay. In terms of that process. And then I think to complete, it is literally, if you want to follow the laws of nature, a bird flying, in a flock can fly 70% further than a bird flying on its own. And this is exactly it. When this deal was originally taken down, it was a $14 million deal. The developer put in $8 million, $6 million came in capital from institutional companies and family offices. The vast majority of them came from Americans. $1.5 million came from our family office, of which we participated $500,000. And that for me is something that I get extremely excited by, because we're a sucker, we're that sucker fish on a big whale with some very, very capable partners that are part of it. And so, ladies and gentlemen, that is everything. If anyone's got any questions, you can literally go to the platform. If you do want to invest, you can go and download the deal summary. You can go look, you can read through it all. You can download this, you can look at the risks. You can read through absolutely everything, all the different parts of it. And when you finally decide, right, I want to invest, and whether you want to put in $10 or $10,000 or $10 million, there isn't an allocation for $10 million, just to be clear. But you go and put in your amount here, you literally go continue, you digitally sign the agreement, and then you go, I agree, and you go make investment. And then you have, waiting for it to happen, the internet's not usually fast, but then you basically invest. And like I said to Gregory earlier, you will then go to your portfolio, you can literally see it's there, and it's on a first come, first serve. And as soon as the equity portion is taken up, we will close it. We will, and you will be the new investor, and the old investors will be equity released out of the deal after the 18 months, like we promised them. And I think, ladies and gentlemen, that is everything. So let me get back to the platform here. Let me just see if there's anything I can do. Can one take out within the 7-year period? Yeah, Peter, it's not recommended. I mean, obviously you can do an equity release, but this was a formal planned equity release. We always said to investors, that after the first 18 months, you would have an option to get out if they wanted to. I don't like people that sort of plan for, trying to get out early. There are obviously deals that are a lot shorter. On our platform right now, you've got one that's 3 years, the one that's 5 years. And so, it's better to plan for projects that are shorter term. Is there anything else that I can help with in terms of anything else from anyone else in terms of why this deal is good? I do remind you, I do think it's really valuable to go and watch this video. So you can see it's called Garth Wellman's Reason for Choosing the Blend. Okay. And you can go watch it. It's literally 22 minutes long. And it was Garth explaining to our family office members to our mastermind members, why he is recommending the blend to all of his family office clients. And I just think it's worthwhile for you to know that. Okay. Is there anything else that I can help with? The thing with the deal launch is we always like to keep it short and sweet. I like to just summarize it. Some people don't like reading through all the information, so I try to make it really easy for people. But equally, for those that want all the detail, I wanted to show people where they'd be able to go and get it and read everything. And so if I'm not getting any questions, Gregory, I hope you've managed to send me a WhatsApp. Can you just confirm? Or otherwise, if you want to give me your number, I can send you a WhatsApp. And, for all the questions, I appreciate it. Namusa, I'm in, so perfectly. Well done, Namusa. I think it's really exciting. Nowadays you can invest in London and Manhattan. When I consider where it's a million miles from when I was looking at those properties in New York, and that's why I wanted to start with those pictures, with those horrible buildings. And now you get to invest, in this type of project. It really makes a massive difference. How did the first 18 months go? Sure, perfectly. We got paid. They were paying quarterly. We got paid on time quarterly. They got the planning in place. They hit their timelines, and now they've gone into construction. So it just, it makes a lot of sense. Okay, Gregory, I got your number there. Perfect. Thank you very much. I will send you a WhatsApp with that number. So yeah. No, you're dealing with good partners on the ground. It's been very, very solid and quite exciting. Okay, I think that is everything. So what I will do is I'll leave my computer sharing. I'm just going to stop the recording. Pause recording, stop. I'm just going to say thanks very much. And as I say, we never rush investors. Obviously, at the end of the day, it's important for you to do your own due diligence. I've tried to share with you all the things that I think are important with regards to this investment. And, it is on a first come, first serve basis, because obviously we need to close out and to equity release for the people that wanted to equity release. So when people say to me, how long will it be open for? It's hard to tell, but in simple terms, it'll be on a first come, first serve basis. This was the first night that I was actually able to do a deal launch. So if you do like the opportunity, then go and participate. I know, Gregory, you've got a time constraint. I'll reach out to you and we can figure out how to solve that problem. But for everyone else, take advantage of, being able to do what I call smart investing. And that is where you use technology. It brings the power of strategic partnerships together and allows us to partner and to invest in the financial capital of the world. Good night, and thank you very much for your time.